Hello and welcome to today's webinar, Retirement Plan Governance and Fiduciaries, the New Frontier. It's my pleasure to introduce your speaker for today, Betsy Piper-Bach, President of ASA Business Services, and Ted Stein, Principal of Offutt Kerman Law Firm. If you're ready, the floor is all yours.
Thank you, Natalie, and thank you for joining us today. Our topic this time is a takeoff of what we did about a year ago, with lots of new information to keep you up to speed in this area of 401ks. You know, historically, the CFO and the accounting staff of an organization would oversee the retirement plan, making sure the employer's contribution was made and would actually manage the assets of the defined benefit pension plan. And then the 401k pension plans came into being, and all of a sudden there's this increasing flow as a source of lawsuits from participants. So as a result, the role of the staff has really changed from choosing investments and overseeing performance to hiring providers and holding them accountable. So today's overview will shed some new light on this changing role of staff and how to protect yourself. To begin, research shows that plan sponsors do not fully realize what their fiduciary roles are. In the 2017 Plan Sponsor Defined Contribution Survey, when plan sponsors were asked if their advisor was a fiduciary to the plan, 33% said no, and 13% said that they were not sure. So in other words, 46% either did not have an outside fiduciary or were not sure if they did. So if plan sponsors understood the consequences of their involvement with the organization's 401k, these answers would certainly be different, as the knowledge of the answer is part of understanding your role as a fiduciary. So we hope you'll find the topics of this presentation helpful in providing insight into how best to offer a retirement plan and protect yourself from a visit by the Department of Labor. So the agenda is the following: process of initiating or replacing a current retirement plan. What are your retirement plan choices? We're going to do an update on the multiple employer plan legislation. We're going to talk a little bit about the regulators, and then processes that we have in place, that you should have in place to protect staff from fiduciary liabilities, and then what if everything falls through the cracks, what are the penalties? So first of all, you really want a research committee. You want someone to do the due diligence of your plan. And in order to do that, you can have an RFP, you can hire someone to do that RFP, or you can do it yourself. But the types of things you're going to ask in that RFP are things like, what is the experience and expertise around the vendors that you're hiring? What types of services are they offering? In other words, they're going to say they are a 316 plan administrator, or that they are a trustee or a directed trustee. But ask them specifically, and that in that role, what services do you provide to me? You're going to ask about contract terms, you're going to ask about conflicts of interest, and conflicts of interest are as simple as, why do they have their own funds in the retirement plan? And you can have your own funds in the retirement plan, so be it the Fidelities of the world, but they need to be able to explain why their fund is the right fund for your plan. So when you're going through this RFP, who are you hiring? The vendors that need to be hired are the same, whether you have a bundled plan or an unbundled plan. The difference is who does the hiring of these vendors. It's either you or it's the bundled provider that has done the due diligence. So you're going to need to hire a trustee or a directed trustee. You're going to need to hire a third-party plan administrator. You're going to need to hire a record keeper, an investment manager, an investment advisor. And doing that hiring is a fiduciary duty, which, as long as you document the process and the decision-making, then with that comes a manageable risk. Yes, it's a risk, but documentation of your process makes that risk more manageable. So let's say you want to reduce your risks further. Well, you hire the record keeper, who might be also the plan administrator, and who might be the directed trustee. So you've hired one provider, and the provider is the one that's going to be responsible for those other vendors. Or even better, hire one trustee, and they will hire all the providers under a fiduciary role. Let's see. So when you're doing this hiring, you're going to have to then, because you have a research committee, you have more than one person that's working with you on this, you have that same committee work to create and design the plan. So you have the vendors, you've decided who the provider is, but now you need to design what are the features in the plan that are important to specifically your group of participants. So it's more of an operational discussion, but it is things like auto-enrollment. Auto-enrollment means every single person that joins your entity, your organization, is enrolled in the plan, and in order to not be enrolled, they have to take action to opt out. That feature in a plan, in 2013, 55% of the plans would use auto-enroll, and in 2017, it's up to 67%. You want to decide whether you're going to do auto-escalate, which means they automatically go into the plan, they automatically come in at 3% or whatever number your group chooses, and it's going to get higher. There's going to be a larger amount that comes out of their paycheck each year as the research group has decided is appropriate, up to a certain amount. So if you start at 3%, in year 2 it's going to go to 4%, year 3 it's going to go to 5%, or whatever numbers you want to use, to a point where you say, and we're going to stop. We're going to stop at 10%, for instance. You're also going to decide how many loans should you allow, what's the percentage match that you're going to give to the plan, what are the entry dates? In other words, you can start today by putting your own money in, and the employer is going to start matching 6 months to a year later. You get to decide that, and that's a clerical decision. It's not a fiduciary decision. And then what are the vesting methods? So once you have your vendors, you've designed the plan, your actual way you deliver this plan is in many different flavors. You could have a multi-employer plan, a multiple employer plan. We're going to talk about the differences of those in a minute. You can have a pooled employee plan, a group trust, or add a brokerage window. So we're going to talk about each of those things right now. There's a lot of confusion in the market between a multi-employer plan and a multiple employer plan. Ted's going to discuss the new legislation about MEPs, and when he talks about that, he's going to be talking about the multiple employer plan, not the multi-employer plan. The multi-employer plan is a union plan, often called Taft-Hartley. It's collectively bargained. Multiple employers are allowed to be inside the plan, but it does have a bad reputation. It got that bad reputation because there's one 5500 that's filed, and all the different employers that are in that 5500 are responsible for everybody else. So if one let's say, manufacturing company goes under, and they're in the plan, everybody else has to make that plan whole. So that's related assets. That's a little risky. So you go to the multiple employer plans. Again, Ted's going to talk more about that, but there are separate 5500s which help protect the assets from each other. So more on that coming. There's the pooled employee plan. That one is, I think, less familiar than some of the others. It's a pooled employer plan that can have one individual plan in it, or it can have a group of individual retirement plans all together. There's going to be one plan provider, so somebody is in charge of it all, and they'll take responsibility for the operation of the plan. It also has one 5500. So again, you want to be careful who's inside that plan. Then there's the 81-100 group trust. This one is all the plan's investments are together. There's going to be a trustee of the group trust who's going to hire the investment manager, who's going to then put the plans, the individual investments inside the plan. But every individual association that joins this 81-100 Group Trust is a separate plan of its own. It will file its own separate 5500s. So you get lower fees because the investments are all together in the 81-100 Group Trust, and it's called a group trust, and if you call it a group trust, some lawyer somewhere is going to say, what kind? But 81-100 is the magic word for a retirement plan, a RESA prohibitive exempted group trust. So some people have issues with a bundled plan. So multiple employer plans are bundled, group trusts are bundled, PEPs are bundled. Well, if you don't like the investments that are in that lineup, and usually in all cases, that lineup is going to be very diversified. But let's say you're someone who decides, I like choosing the funds I want, so I don't like this plan because it doesn't give me that opportunity. There is something called the self-directed brokerage window. It can be added to any bundled plan you choose. Today, there's about 10% of all plans that use it. And part of it is, the good news is it's not your legal responsibility for what your participants do if they use the brokerage window, because the brokerage window allows your participants each individually to have their own stock brokerage account. They can go straight, it's usually TD Ameritrade or Schwab that offer these, but they attach themselves to your plan, and you as a participant can go and buy any mutual funds you want, any stock you want. It's up to you as a participant to choose your investments, which means you do carry the risk of your own portfolio's performance. What are the limitations? Sounds great, right? All of your participants can either take the bundled source or they could choose the brokerage window and invest wherever they want. Well, here's the risk. You're going to have, I call it the bell curve of humanity. Some of us have such large associations, we're not sure we want every single person in our association to be able to have control over their retirement money. You may have that one gambler in the group who puts all of their money in a single stock. They could do that. Well, what's the risk? They've now been employed by you. You allowed them to have this brokerage window, and they lost all their money of their own choosing. So that is the risk, the pushback, and probably why there's only a 10% usage. Because once you offer it to your plan, everyone has to have access. You can't eliminate and just say, oh, we're only going to have the top 25% of the members be able to use this. So that's what you want to be careful with. Okay, so that's an overview of the types of plans that are available in the market. But now there's some legislation, which some of you may be following, on the MEP, and we're going to have Ted update us on that side. Ted?
Thank you, Betsy. So just to recap very briefly, the multiple employer plans, the MEPs, is proposed and will be a different sort of association or group that will offer a pension plan that other employers can participate in or subscribe to. So as Betsy mentioned, historically the Taft-Hartley plans were defined benefit plans, union plans that were large, and there were multi-employer who subscribed. And as Betsy indicated, if there was a failure in one, then the others had to make do. And if one of the member organizations wanted to get out, there was withdrawal, or there is withdrawal liability. It could be quite substantial. So that's the multi-employer construct. We've also had situations where multiple employers who are related have been able to essentially have a single plan because they're all part of an affiliated structure. So that would be a parent organization and subsidiaries where there is a common control group or an affiliated service group, and that also has been recognized as a single employer plan. So this is new. It's called an MEP, and recently the President issued an executive order. This is on August 31 of this year, directing administration officials to expand retirement savings options by revisiting rules on open multiple employer plans and issuing a proposal within 180 days. And so the Department of Labor has actually done that. As of October 24th, they have published in the Federal Register a notice of rulemaking, and they've solicited comments which are due in 60 days on December 24th of this year, and they are proposing to clarify the definition of employer under the statute, which is ERISA, the federal regulatory structure that regulates qualified plans. And the problem is, at least as identified by the Department of Labor, is that it's unclear whether the definition, or it has been unclear, and the courts have found this, as to whether the definition of employer would encompass these multiple employer plans, these MEPs, in cases where the employers are unrelated. They're not affiliated organizations. They're not in the same corporate structure of parent and subsidiary or sister corporations. And so the definition of ERISA, in Section 3.5, defines the employer as any person acting directly as an employer or indirectly in the interest of an employer in relation to an employee benefit plan, and includes a group or association of employers acting for an employer in such capacity. Well, you can understand that the problem with the definition is it includes other terms that are undefined, unexplained. So courts have kind of thrown up their hands and said, you know, we don't really know if an MEP or multiple employer plan where the entities or the employers are unrelated, unaffiliated by structure, we don't know if that's really allowed under ERISA. And so the Department of Labor determined that there is a gap and that they need to clarify. And so they've issued this notice of proposed rulemaking as of October 24th. And what they've come up with is essentially a couple of bright line tests where they will include in the definition of employer so that essentially one plan can represent or be participated in by multiple employers who subscribe. If there is, for example, a bona fide group or association of employees, and what they're saying is there needs to be, the primary purpose of the group is to offer MEP or multiple employer plan coverage to employer members and their employers, but they also have to have some commonality, some substantial business purpose unrelated to just offering benefits, which they share, some commonality of interest. So that would include a trade group that represents one industry, or some type of unrelated employees who are in a particular construction or restaurants or some other particular business. So there's a commonality of interest. They're also clarifying the definition of employer to include what is known as professional employer organizations, or PEOs. These are special constructs of companies that essentially have clients who are themselves employers, and the PEO enters into a contract with the different employers who participate with the PEO, and the PEO handles HR functions, payroll, and other functions, but also as a single 401k plan or a defined contribution plan that all of the organizations that are contracting with the PEO can be a member of. So that's going to be another, according to the proposed rulemaking, that would be another area where a group of employers who themselves are unrelated to each other can participate in a single professional employer organization, a PEO, and be able to take advantage of and participate in a common or single 401k or other type of defined contribution plan. So that would be a huge advantage. The idea is to expand, and particularly to smaller businesses, and there's provisions also relating to sole proprietors and others, essentially who are working their own businesses, and because they are individual employers, do not have obviously the resources or the market share to obtain the best in terms of fees that are going to be charged by vendors, record keepers, investment advisors, and others. And yet they want to offer to their employees, how many employees they have, or themselves as employees, the advantages that larger organizations have. And that's one thing that a multiple employer plan can do, either through a bona fide group or association or a professional employer organization. So a survey conducted in April by Prudential Financial Incorporated and Morning Consult found 78% of American workers support the idea of MEPs. And that's not really surprising for reasons that I've described. Making it easier for unrelated employers to join open MEPs also is the focus of several legislative proposals, not just the notice of rulemaking by the Department of Labor. Those proposals include the Bipartisan Retirement Enhancement and Savings Act of 2018, which is co-sponsored by Senate Finance Committee Chairman Orrin Hatch, outgoing Senate Finance Committee Chairman, I might add, and Ranking Member Ron Wyden of Oregon. It's also being considered in the House as part of a broader tax reform 2.0 effort. There are various constraints applicable under the existing statute, so although regulatory expansion of MEPs is a good first step, it may not be able to achieve nearly the same level of assistance to small employers as legislation can. Modernizing the tax code disclosure rules on MEPs to be both more understandable and useful for employees also would result in a less costly product, as well as less burden for employers. The Senate bill would create new pooled service providers who would administer open MEPs, and the Departments of Labor and the Treasury, the Internal Revenue Service that is, would issue regulations to elucidate which services the pooled service providers must offer and what they must disclose to employers that join them. The pooled service providers would be a fiduciary. Each employer would still be responsible for picking and monitoring a pooled service provider and the plan's investment lineup, but the lead would be taken by the pooled service provider. And I'm going to come back to that a little later in this program when I discuss some of the class action cases that have been brought against large universities, elite universities in fact, and some of the recent decisions that have been entered by judges in those cases. So there are certain negatives. The concern is that RESA reporting and fiduciary obligations may be treated sloppily or ignored in toto if the employer is not overseeing the activity and being held accountable. Potential abuses might include layering of fees, misuse of assets, or falsification of benefit statements. Despite an overall pessimism about the likelihood of getting anything through Congress in an election year, there is some optimism for improving the regulatory landscape for multiple employer plans, at least for smaller employers. And that's in some measure due to the President's executive order from earlier this year and the new Department of Labor initiative and their notice of proposed rulemaking. The former chairman of the Senate Committee on Health, Education, Labor, and Pensions, Tom Harkin of Iowa, has discussed in the past the pros and cons of multiple employer plans. So this is an idea that has been gaining traction for a number of years. And he wrote, given the bipartisan interest in this area, I'm optimistic we can reach an agreement in the Senate that will help employers pool their resources without compromising the participant protections under the law. Now, one of the changes that is being discussed at the Treasury Department is changing the RMD rules. RMD is the required minimum distribution, which is in fact part of the law that's required now, so that when a plan participant or employer, former employee, reaches the age of 70 and a half, that individual has to begin taking out on an annual basis a certain amount of money that's in his or her retirement plan or individual retirement account, IRA. And so in 2012, the Government Accountability Office, the GAO, analyzed 2009 data and found that $175 billion in defined contribution MEP assets, multiple employer plan assets, represented 6% of all defined contribution assets, while defined benefit MEP participation shrunk between 2001 and 2009. Defined contribution participation increased 24% and continues to grow. The MEP's model is a way to foster growth through lower costs of record keeping and investment management, ease of administration, and added fiduciary protections. The proposals also seek to foster more open multiple employer plans by having the Labor Department ease its stance that such plans must have a common nexus among participating companies, reaffirming the open MEP concept. And this is really something that, as I indicated, legislation is going to have to be passed to ensure that it's compliant with RESA, because right now the Department of Labor is trying to take the initial first step, which is to look at groups and bona fide groups and associations and these professional employer organizations, and using those entities as the plan sponsors and plan administrators for these pooled plans that have multiple employer participants. And as Betsy had indicated, the IRS has this one bad apple rule where an employer failing to meet tax qualified plan criteria can disqualify an entire multiple employer plan's tax qualified status, which could have disastrous consequences, require a reconstituting of a plan's assets, or the plan would suddenly have to, or the participants who have taken distributions would have to pay taxes, including penalties. Could be disastrous, as it would be in any individual plan context where this issue occurs. So there are two bills being introduced in order to eliminate this problem under both Treasury and Department of Labor regulations. And despite an overall pessimism about the likelihood of getting anything through Congress, although now that the midterm elections have occurred, there may be some opportunity between now and the end of the president's term to get something accomplished here, because there won't be an election again until 2018, a general election. So there's some optimism for improving the regulatory landscape for multiple employer plans, at least for smaller employers. And again, going to Senator Harkin's former comments, given the bipartisan interest in this area, I'm optimistic we can reach an agreement in the Senate that will help employers pool their resources without compromising the participant protections under the law. And it does seem that this is really not a partisan issue and can be something where senators of both parties can come together, but we shall see.
It's just taken longer than Senator Harkin thought it was going to take, right?
It did. Unfortunately, he was not able to see the day as a member of the Senate. So there are some unanswered questions. For example, does everyone use the same plan lineup in terms of investments? What would that look like? How will the MEP be distributed? Would record keepers take on the role of the pooled service provider and try to encourage small plans to join? Would existing brokers start different MEPs? Congress is leaving these details, and they're important details, up to Treasury and Labor Departments and the private sector providers. And it's interesting that the two regulators, the Internal Revenue Service and the Department of Labor, of these MEPs, multiple employer plans, the IRS is already open, and their regulations already allow the MEPs. It's really the Department of Labor that needs to get on board.
So no matter what type of plan you have, there's a fiduciary role. So even though the MEPs are trying to get to be helpful and help the smaller organizations, even the larger ones, more easily administer their plans, you're still a fiduciary. And we're going to talk about why and how you become a fiduciary, because there's some need to protect yourself in that role. So how do you become a fiduciary? You can exercise discretionary authority or control over management of a plan or its assets. So the fact that you have hired whichever you want to hire, the MEP, the 81-100 Group Trust, the whichever, you are now a fiduciary. Or if you render advice for a fee, and that's mostly for consultants. Lastly, if you exercise any discretionary authority or responsibility in the administration of the plan. So we're going to talk about that one a little bit later, the last one. Okay, just a reminder, we did this on a year ago, and you've probably been to if you've attended these sessions in the past, you've seen this comment before this discussion, which is who are fiduciaries, and it can be the trustee, the directed trustee, you, the plan sponsor, the 338, the 316 plan administrator. So there are lots of people to share your fiduciary role with. So being that you are someone who appoints the fiduciary, any of those that you've appointed, you do have someone to share your risk with. Because once they're appointed to a fiduciary role, they are now a co-fiduciary with you, and you share the responsibilities of making sure the plan is run according to the regulations. The TPA is the last one I want to address. So the Plan Administrator 316, those are different. That person, as a fiduciary, is making decisions. They're making decisions as to who can have a hardship loan. They will be signing the 5500. They're the ones the DOL contacts if they ever have a reason to come do an overview of your plan. So this is not the person in payroll that's submitting the payroll contributions to the provider. And it could be, it may be in a small organization, it could be the same person. But if you are someone that's making decisions about how to grant loans or hardships or who gets a quadro, that's a fiduciary role. If you are someone who only is submitting payroll, that is not a fiduciary role. So if those are people that can be fiduciaries, Ted, can you just talk a little bit about what that duty is then?
Yes, Betsy. So the fiduciary duty in the context of RESA and pension plans is twofold. And the first part of it is the duty of loyalty, which is not really a focus of our effort here today or the recent cases, but it is very important, and that is that the fiduciary must act solely in the interest of participants for the exclusive purpose of providing benefits under the plan that they administer or that they are trustees of, and paying reasonable expenses. So that's the duty of loyalty. What is front and center today, particularly in cases that I will discuss shortly, is the duty of prudence, or the duty of care, which is similar to the tort duty of care that we have encountered in negligence cases throughout history of our legal history, going back to common law in England. But under ERISA, and I will quote this is the definition that's in Section 404 of ERISA. The duty of prudence requires a fiduciary to act with the care, skill, prudence, and diligence under the circumstances then prevailing that a prudent man, I would change person, acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. So what's also clear from the case law that has interpreted it is that this is an objective standard. So it doesn't require a fiduciary to be clairvoyant. The law does not require any fiduciary to guarantee a result, that somehow investments will make a straight line increase over the years. It's the process, though, that's critical. And therefore, it doesn't matter if the fiduciary has the experience or has any any prior experience as a fiduciary, but the fiduciary must go out and get any assistance that he or she needs or it needs to be effective and to exercise this care under like circumstances, or it can be held accountable. And therefore, that's essentially what the statute requires and what the regulations require. Betsy?
Okay, so after all that legalese, what should you do, right? You mean we need a 401k committee. This is the thing that will help you on the inside protect yourself from whatever bad stuff can happen under that legal description that Ted was giving you. There's actually nothing in the regulations that says you have to have a 401k committee. What it does say is fiduciaries should review plan operations and investments as often as necessary and appropriate. So that's what you need to do. And that's why you form a 401k committee. And this is how you do it. Make an agenda. Be easy, date, time, normal, you know how to hold committee meetings. And what should be on that agenda? Well, for instance, let's say it's plan, if you are, so it's all of these, but let's look at plan operations or regulatory updates. What does that mean, and who has to bring that to the committee? Well, Bipartisan Budget Act of 2018 happened. You need to know what that is and that it was passed, because this impacts you. When you are granting your hardship withdrawals, now your participant no longer have to stop contributing. Used to be if you took a hardship withdrawal, you could not contribute to the plan for a year. The new law says, no, that's not necessary. You could keep contributing after you took your hardship withdrawal. Also, you used to have to take a loan before you took a hardship withdrawal. Well, now that's not necessary. The third thing is, in the past, you could only take up to half of your retirement plan assets that you put in, or up to the maximum of $50,000. Now that calculation is based off the money you put in and the money the employer put in that's vested. So there's a new mathematical formula you need to know. And because of this, you need to amend your plan. The plan needs to allow you to do those things. So oftentimes you will have an advisor to your plan that will keep you up to date. Sometimes your record keeper will. For sure your plan administrator, your third-party plan administrator will. But it ultimately is your responsibility to manage your plan under the current regulations. So the agenda, I'm going to go back here. The agenda for your meeting should have all of these in it. Statement of purpose, well, your committee's together to help provide a better retirement plan for your participants. Goals, your goals are to get 85% of your participants to participate. Or maybe your goal is to get everyone contributing at 6%. But what's the purpose of your committee and everything you do? It's to make a strong retirement for your participants. You need to have an investment policy statement that is reviewed. You need your insurances, which we'll talk about in a little bit. Again, compliance topics, which should come under the plan operations or regulatory updates, as well as in compliance, you're going to do the formula to make sure that your highly compensated aren't overcompensating more than your less highly compensated. So all of that needs to be reviewed and documented. So a little bit about investments. Now remember, you've changed from investing to actually only overseeing the investments. So you need to ensure that they are diversified. Ted referred to Section 404. In that same regulatory group, there's a 404C, which says you need to diversify holdings. You need to provide holdings to your participants that are diversified enough that they can't possibly lose all their money with one fell swoop. So what are those types of things? Well, first of all, you need a qualified default investment alternative. And the reason you need that is that when a participant goes into the plan and they don't ever go back to the website to change their investments, you have to be protected from wherever you put their money in that plan, because when you give a contribution to the provider to put into the plan, you are the one that is directed where that money is going if the participant hasn't directed it. So you set up default investments, and it needs to be either a balanced fund, target date funds, those are the ones that have the years attached, you know, you're going to retire in 2015, 2020, those are called the target date funds, or a managed account. But you need to have at least one of those in your plan so that you can be protected by someone giving you their money and then never touching it again. So what are people putting in their plans? Wouldn't you like to know what everybody else is doing? Well, this study was done by Deloitte last year, and this is what they found. 90% of plans offer actively managed domestic funds. There's the target date funds. 88% offer passively managed funds. And then it goes on down the list. So if you're looking, we're going to talk a little bit more about the actively managed versus the passively managed, because there's a great debate in the industry about why would you pay so much to have an actively managed fund when passively managed over the last 8 years just have constantly gone up, right? The S&P just continues to grow, and I'm sure it's always going to grow. That's not, that was the joke, not happening. But of an actively managed fund and a passively managed fund, which one do you think is less expensive? Of course, it's the one that doesn't need a lot of attention. But what has the better performance? Okay, not which one has the lowest fee or highest fee. Which one has the better performance? Well, it depends. But that's what you need to pay attention to, that relationship. It's not always about fees, but more about that in a moment. These are the investments that are trending. So there's been an increase. 32% of plans now offer Treasury inflation-protected mutual funds. 15% offer socially responsible funds, and by the way, that's continuing to grow. 10% offer exchange-traded funds. And exchange-traded funds are much like mutual funds in the amount of investments inside them, but that's about where the relationship ends. They are actually less expensive and gives you the diversification you want. So that's why those are growing. All right, a little bit about fees. You're responsible on the committee to oversee all fees. There are fees from the advisor. There are fees inside the investments. There's record-keeping fees. There's a document called the 408B2 fee disclosure. The term is fee disclosure. There's a couple of them, and that's why I said 408B2. But if you're benchmarking your plan or going out to see, what your plan is compared to anyone else's, just because you want to know, ask for the 408B2. It's required to be provided upon request. Once you have a plan, in fact, with your plans today, you all have one. If you're just a participant, so you're not in charge of everything, you'll have a 404A5, same fee disclosures. So if you're a participant, ask for your fee disclosure as a participant. If you are a plan sponsor, you ask for the plan sponsor fee disclosure. So when you are doing your benchmarking and you're looking at the fees, you really want apples-to-apples comparison. And why did I bring that up before when I was talking about passive funds and active funds? Because benchmarking is important. If you are going to compare your fund to someone else's, you want to make sure that if you have passive funds, you're comparing it to passive funds for fee purposes. Because what you're going to find when you do benchmarking is someone that isn't doing it the right way is going to bring in a bunch of passive funds and compare it to your active fund and say, well, you're too expensive, so you need to change. Well, no, it's not all about fees. You should be comparing your fund to other actively managed funds and then bring in a passive if you want. But it shouldn't be all passive because that's not what your fund is. These are some ways to benchmark your plan. There's an organization called Brightscope. They will compare your fund, your plan, to every other plan they have in their database. Or you could choose Fiduciary benchmarks. They will do the same thing. They will compare your plan to every plan that they have in their universe. Or you can hire a consultant. And a consultant will say, most consultants will say, let's see, you have this active plan. I'm going to go find 3 other providers. And they'll tell you, it's T. Rowe, it's MassMutual, it's Lincoln, it's whatever. And you'll see the names of those people when they do the presentation to you. So it's not a huge database, it's specific plans. But those are ways that you can actually benchmark your plan. Now, the good news about all this fee stuff is that it's actually becoming more transparent. In 2015, 50% of plans paid their record keeper out of the investment options. Those are those 12B1 share classes. In 2017, that's decreased to 39%, mostly because people want to be transparent instead of hiding their fees. What has increased is just writing a check to the record keeper. 2015, only 41% of the plans did that. In 2017, 53% just write a check to the record keeper. Then there is a newer method, which, I mean, it's been around for a while, but it has just more transparency. So you can get fee credits from the mutual fund, whichever way you receive those. Instead of using it to pay the record keeper, because then you're kind of hiding fees again, you actually give it back to the participants that paid it. So in other words, one participant has 5 funds, another participant has a different 5 funds. The first set of 5 funds has been paying fees to the record keeper. The second set of 5 funds hasn't been. Well, what was happening is those that were paying the extra fees were paying everyone's fees. This way, only the funds, the people that have those first 5 funds that were paying the fees are going to get credit. They will get money back. Those other participants that weren't paying the fees and were benefiting from the first group no longer have that benefit. So if you pay it, you get it back. So that's, a lot of record keepers can now do that, and that's important to ask about. So lastly, if for your 401k committee, you now have the oversight responsibility. So make sure you review all activities that have happened since your last meeting, discuss the next actions, and assign members to the committee to follow up on issues, and document. If the DOL should come in, they will ask for your 401k file. You need to have documentation on how you made your decisions. So let's say things fall through the cracks. Ted, what happens?
Thank you, Betsy. So there are penalties and there's fiduciary liability, both via the Department of Labor's potential investigation and enforcement authority, and also from private civil actions, primarily class actions, on behalf of potentially affected plan participants. So with respect to the Department of Labor can come in and investigate and take action against you in court and obtain a 20% civil penalty for all amounts that are dispersed or distributed or lost because of a breach of fiduciary duty. The Department of Labor also can seek criminal penalties for willful actions, which could include jail time, and they can seek to restore losses to the plan from the individual trustees or the individual fiduciaries from their pockets back to the plan, which could be a very expensive proposition. A lot of, with respect to civil actions, there's been a lot of press about class actions that have been brought. As you can see from the slide, lawsuits have been filed against financial services firms for self-dealing. Betsy mentioned the idea of the financial firm using its own proprietary products, which is not forbidden, is not barred, but it has to be financially suitable, and it also cannot be excessive in terms of fees. Alliance settled, a big financial industry firm settled for $5 million a class action. New York Life settled a class action for $3 million. And those are on the private side, the 401k side. On the nonprofit side, the 403b side, you may all be aware that it's one law firm in St. Louis has brought a series of class action lawsuits against some of the leading universities and colleges throughout the country, including MIT, NYU, Yale, Duke, Vanderbilt, Johns Hopkins University, University of Pennsylvania, University of Chicago, and on and on. And the basis for these suits has been allegations by class, in some cases thousands of plan participants, that record keeper fees are excessive, that the retirement plan committee and other fiduciaries and trustees have fallen asleep at the switch and have allowed essentially the record keepers to gouge the plans for excessive fees. And in some cases, the actual investments have been challenged, whether it's a real estate fund of the TIAA or CREF or one of those organizations, or a mutual fund. Again, excessive fees or underperformance, these are the allegations. And I do want to just refer briefly to a case that was decided after an 8-day bench trial. That's a trial before the judge in the U.S. District Court for the Southern District of New York. And the judge issued her opinion on July 31st of this year in a case that was brought against two huge pension plans maintained by New York University, NYU, one for the faculty and administration of the university and one for the faculty and administration and staff of the medical school. Both funds managed in excess of $2 billion. That's assets under management. And after the 8-day trial and after considering many hundreds of exhibits and trial testimony, the judge concluded that, awarded a judgment for the defendants that there was no breach of fiduciary duty, that the plaintiffs had failed to make their case, and that there had been no proof of actual harm to the plan participants, moreover. But I think there's a couple of lessons from this case and also from these other cases. And one is that, as Betsy has indicated and as I've indicated, there's an ongoing monitoring function of fiduciaries and plan retirement committees members. You can't simply set it and forget it, as he used to say in the advertisements. There has to be ongoing review to make sure that the record keepers are doing their job, that the investment advisors are doing their job, the investments are appropriate, the fees are appropriate and not excessive. And one of the things that the judge in the New York District Court found, which she said was concerning, was how little, in fact, the retirement plan committee chair and members knew about what their jobs were. And she stated in her opinion that blind reliance on vendors and advisors is not tolerable, is not tolerated. That is a breach of fiduciary duty. And she even quoted some of the testimony saying that from the co-chair of one of the plan retirement committee, saying it was appropriate for her and other committee members, this is the NYU plan committee, to rely upon the plan advisor and consultant to determine reasonableness of fees, and that she and the committee didn't have to do anything about to test the assumptions or the conclusions of the vendor. And so she wrote that this is quite concerning. So it is a wake-up call in a sense. It's good news for the retirement plans because obviously there has to be proof, and there wasn't in this case. But it's also a wake-up call that fiduciaries have to do a better job of understanding their responsibilities and carrying them out.
So there's another way to, thanks, Ted. Stories are actually more interesting than the regulations, I hate to tell you. We've talked about the committee being a protection for you, but you should also have insurance. If there's a fidelity bond that's required, doesn't cost a lot, 10% of assets up to $1,000 in total. So that's required. Everyone that has a 401k plan needs to have that. And then fiduciary insurance, which you don't have to have, but that is good insurance to protect you from your decision-making as a committee. So in conclusion, I'm just going to say that the new frontier is here, be it the multiple employer plan. We'll see how that shapes up sometime after December, or just the role you have in connection with your 401k. Remember the 2018 Bipartisan Act, where the changes have been made in some of the administration. Your role isn't the doer anymore. It's the overseer. It's making sure that things are implemented, that you have the right processes in place. So the new multiple employer plan might solve for fees, but probably not for the fiduciary role. So need to stay in touch, be educated, keep informed, and hopefully this was one of the ways that you are doing that, is attending some of these sessions. So thank you for anyone attending. And there's one question, which is, how do you determine reasonableness of fees? That's back to the benchmarking. If you do not have to ask for an RFP, by the way. You can ask for an RFI. An RFI means you go out, a consultant helps you get some other funds to compare your fees to, and everyone you talk to knows you're not changing your plan. You're just getting information. And that's really, I think, a fairer way to go out to the providers so that they understand this is just, they are helping you out. And they're not going to beat down your door trying to get you to switch your plan, which is what an RFP does, right? People know you're looking, and so they're trying to help you make that decision. But then also, it was back to that slide, which I might be able to find here. Here, bright scope, fiduciary benchmarks, or hiring consultants. And document that you've done it and keep it in a file. One more question, that's really all the time we have for. Is the 401k committee supposed to be a staff committee? You know what? There is no definition for it. It's better if it's paid staff versus a volunteer that's coming in and moving out. You will certainly have different opinions on things as you put a group together, but it does not have to be staff. It does not have to be, it's not required to be volunteers. It's just better for insurance purposes, for one thing, to keep it to paid staff. But that's really the guidelines, just more of a best practice. Thank you, everyone, for attending, and continue to reach out to us if you have questions, and I will ask Natalie to chime back in.
Great, thank you so much. First, I'd like to thank all of our attendees for joining us today, as well as both of our speakers for their excellent presentation. Before you shut down today, I'd like you to take a minute to please fill out the survey you'll see. We appreciate your feedback in order to help improve future webinars for you. Again, thank you for joining. We hope you have a wonderful day.